Hey guys, how you doing? Good to be here. Thanks
Good.
for the invite.
Thank you for joining us. And obviously, we asked you to speak today because tomorrow you're probably going to be spending the day crying.
No, I support the All Blacks, mate, so we're all good to go.
Oh, perfect. Perfect.
Yeah,
Awesome. Well, the stage is all yours then.
cool. Thanks, mate. So just a quick update of where we're at in finance world at the moment and what's going on. It's been some pretty exciting changes, as everyone here has probably been hanging out for. Change of government means some pretty positive change in the investment space. And although the banks haven't jumped on those changes yet, there is talk in the background at the commercial level and the wholesale level, which will trickle down to where we borrow money, with them interest deductibility coming back into the fold. As Matt Harris and them will cover from an accounting perspective, it is a staged reintroduction. So at the moment, you get 50% tax deductibility on your interest expense. It will be for another year. So from April, it'll stay at 50%. The year after that goes to 75%. And the year after that, it's back to 100%. Now, what that means from a borrowing perspective is that as interest deductibility has dwindled over the last 2 years, the banks have increased the amount that they hold back from rental and servicing income to account for less taxable write-off and the impending associated income tax that comes from earning a rental income. So with some banks, you get as little as 60% of the rental income that your property makes to put towards debt servicing. So when you've got a property that generates $500 a week, which sounds great, sometimes it's only $300 a week that's allocated towards your debt servicing perspective. And that's why a lot of investors who go into buy and hold run out of road really, really quickly when they've bought one or two or maybe three properties and they can no longer service any more debt. So that's a really big change. And we're starting to see two of the banks have already eased up on that. So we're back up to 75% with those guys of the rental income, which is an improvement on the debt servicing side of things, which means you can borrow more money basically. Lending appetite is at its best that it has been for the last decade. And I know that you'll often hear that it's so hard to get a mortgage and it's really difficult to borrow money. And that's just not true. So it's easier now to borrow money than it has been for a decade. And that's because the banks are struggling. So they're 40% down on business and their multi-billion-dollar profits are now becoming single-digit profits. So there's a lot of hurt from the banks, which a lot of people think is a great thing, but it's actually not. Like, we really need profitable banks, because if the banks are profitable, we have a secure financial industry and they have an aggressive lending appetite to put funds out to market. So what we're seeing at the moment is that banks are more willing to work and rework and rework and rework deals to find a way to get a deal across the line than I've ever had since I've been a finance advisor. So I regularly will get a call from an assessor saying, hey, look, this deal doesn't work as presented. Have you got 10 minutes that we can just go over some options to see how we can get this to work? Now, 2 years ago, at the peak of the market, that was just a swift decline. Nope, sorry, not for us, out the gate, on to the next. And that's the end of it. So from a buyer's perspective, where you guys sit at the moment, we've got a lot of road and a lot of rope from the banks to really push the boundaries and the envelope of the original comfort space. So we're getting a lot more deals done that are way outside traditional bank parameters at the moment. The lender panel is improving, so a lot more banks are growing their appetites across multiple channels. We're seeing the banks easing up on multi-unit or multi-house dwellings. So at the moment, you can get either build development money or infill housing money for 4 units on a new build site, where previously it was restricted to 2, and that will still stay as standard residential lending. For those that don't know the difference, standard residential lending is a 30-year mortgage, standard residential rates at about 6.5% to 7%, and 5 years interest only. If you build more than that, so we do quite a bit in the development space and the bigger bank commercial lending in the non-bank space, that would traditionally become a 15-year loan term, principal and interest repayments, no interest only. So from a debt servicing perspective, it becomes a whole lot more expensive to service that level of debt. And often it's what kills many infill housing deals or the flips that you guys are talking about doing, where if we can keep it at residential, you've got a long road, 30 years, it's really easy to service debt on those projects. And sometimes you'll find that infill housing, you can flip one, keep one as a hold, be mortgage free or lowly geared on that, and that will allow you to use capital to do new projects, but also build a passive income in the background. There's a bit of headroom in the LVR space for investors at the moment. So traditionally, we were at 60% LVR, which means you needed 40% deposit. That was eased to 35%, but there are still options where you can buy investment property at the moment, existing residential stock, with a 20% deposit. So 80% LVR with what we call a near to bank lender. So there'll be the likes of Resimac, Liberty, Avanti, Bluestone, Select. But the cool thing is that once you've held that property for 6 to 12 months, if your intent is to hold, we can actually refinance that back to main bank at a dollar for dollar refinance, so no equity out, but at 80%, and it falls outside the Reserve Bank regulations, so it's an exempt transaction. So there's no tax implications, there's no breach of their LVR restrictions, and all of the banks do it. It's not something that they talk about, but there is an option that if you can bite the bullet for a year, you can do a non-bank deal for a long-term hold strategy and then move it back to main bank, which obviously then will improve the cash flow that you've got. There is some really cool opportunity at the moment for releasing equity out of properties with no specific purpose. And you just need to be able to support the borrowing. So traditionally, main bank doesn't want to give you walking around money. They want you to have a purpose. So is it an investment? Is it another property purchase? Are you repaying debt? All of those carry on. But we've got a couple of lenders that we work with that will allow us to withdraw up to $500,000 of just straight equity, cash into your bank to do whatever else you want. So for starting investors, that kind of equity is not necessarily available, but for property investors who've got a reasonable sized portfolio, we've got some options to pull out some quick cash that you can then be a cash buyer or look at your flips for cash funding projects like that, or use that to leverage up to go into bigger projects. There's quite a lot of play in the non-bank space, and I know that Corin's got someone who will talk about the non-bank sort of securitized lending coming up to talk about the options if the bank says no. And there's a lot of money in that space at the moment. It's a little bit more expensive than the banks, but they're keen. And that's traditionally where we will do most of our funding for flipping properties, because banks don't like property traders. They don't like flippers. They don't like developers. They don't like the risk that comes with it. And if you use bank money often enough to flip properties, eventually you become tainted as a property trader, and they can often revoke your funding line. So you've got a better opportunity to raise capital from the bank if you're raising against securities, use a non-bank lender to flip the property, pull out the proceeds and go again, keeping your bank facility in place. Costs you a little bit more, but it is a much easier road to money. And generally the barrier to entry for non-bank money, you can get funding within 24 hours. So, and they will generally fund some pretty rundown stuff that you can fix up, renovate, recycle the equity out of, and then flip, or recycle the equity out of and then refinance back to main bank again. So that's sort of my update for where we've got at the moment, guys. I'll open the floor to some questions, and so feel free to fire ahead.
Thanks for that, Brendan. We'll have the questions coming through. So as mentioned, get them into the chat. But what about for our Aussie friends? Obviously that's been a challenge recently. What are some things our Aussie friends can be doing?
Well, actually, the thing is that it's always been open to Aussie borrowers. The biggest barrier to entry for Australian investors is that there's a really heavy debt shading and income shading that's applied to income earned in Australia. So liabilities held in Australia are viewed at 100%. So if you've got a mortgage there or any associated debt, they take 100% of the debt. And across the various lenders, we will have anywhere between 100% of your income or as low as 50% of your income, depending on the lender and the appetite and whether you are self-employed or PAYE over in Australia, to use towards debt servicing. So you could have a really great income in Australia, but once you take your debts into account and shade it by 50%, it doesn't really amount to much here. But that appetite is changing as well. A couple of the main banks are now giving us 80 and 90% of debt servicing and income to put towards debt servicing here. They're taking dollar for dollar. So 100% liability, 100% income. They're taking rental income out of Australia as well, which wasn't previously allocated in the main bank space. So there's definitely an easing of those restrictions. And I suppose the biggest things that you could do is make sure your accounts are clean. So I'm not talking about don't drink a latte and have your Friday night beers and go out for coffee and that sort of carry on, because fortunately, the powers that be have seen sense and they're unwinding the triple CFA and the absolute death of common sense that they imposed on us for the last 3 years. And with the new government, they will pretty much unwind all of that bullshit. But you will see them still quite pedantic on account conduct. So no unarranged overdrafts, no missed payments. And guys, deals are getting declined for $1.25 unarranged overdraft, where you've bought something at the dairy and it's just gone through and you've put the money in, don't like it. They still don't like it. That clean account conduct is an absolute must. So 3 months, squeaky clean account conduct. If you are looking to leverage up and borrow to buy, my recommendation is put the money aside that you will spend on the new mortgage into a savings account, label it debt servicing mortgage money, so that the banks can see real world evidence that you can afford the debt that you're proposing. And by doing that, we're often able to circumvent that sensitivity that Kyron mentioned earlier, where they're adding a 3% margin on and say, yeah, we understand that. However, we can demonstrate real world affordability here based on what we're proposing, and we'll have a saleable asset that if it really turns to custard, we can flick on the property and exit out of it. And, you know, in the last month or so, we've probably got 6 deals like that across the line that started out as a straight decline. So it's really easy. If you can prepare to show that you can do what you're asking them to let you do, generally we can get it across the line.
Okay, cool, perfect. What about interest rates? How negotiable are they at the moment?
Zero negotiation on interest rates. The only negotiation that you get is by going to a different bank. So because everybody's in the same boat. Wholesale swap rates are what they are. The funding costs are high, but banks are now building margin for when the rates drop. So we're expecting wholesale rates dropped last week and 2 of the banks put their rates up. So we're expecting to see a stagnant or upward trajectory of probably at least another 25 points on interest rates, even as cost of funding and wholesale swap rates on the bond exchange come down. And I think over the next 12 to 24 months, you'll start to see bond rates come down, wholesale swap rates come down, the OCR eventually come down, and then trailing behind that by about 25 to 40 points, bank rates will start to come down. So we think this is just a money grab, and they're building excessive margin in to account for cheaper cost of money that is coming. So no, unfortunately, no real negotiation on interest rates. You can negotiate on cash, so we're still getting good cash contributions for borrowing, as high as 1%. So, and that's just cash that the bank will give you to borrow money. Keeps you loyal to them for 3 years, but it's handy to pay for all the associated expenses going through investment purchases for DD, legal fees, registered valuations, all the other carry on.
Yeah, cool. I've talked to a few people recently who are looking to try offset their mortgage payments by keeping, you know, with their savings, etc. They're wondering whether they pay down debt or no.
No, don't pay down debt. If you can, do a debt restructure, put a revolving credit or an offset account in place, which will allow you to deposit savings and surplus funds against the debt, reduce interest and reduce outgoing costs, but maintain access to cash. Because once you give it back, you have to ask permission. And under the new regime, doing a finance application is a tedious process. It is long-winded with a whole lot of information. And obviously, the more portfolios and accounts that you have, the longer it's going to take to do something like that. So in the current environment, hold on to cash. Debt restructure is cheap, easy, and achievable in 48 hours. New application, 2 to 3 weeks. So if you've got cash, keep it. But there's really easy restructuring that we can do to immediately improve position on cash flow, interest rate, manage that higher level of interest rate, and you can have a sort of a paper-based debt reduction using an offset or a revolving credit, but it keeps handy cash available for the next transaction.
And is a revolving credit available with non-bank lenders too, or is it only the mainstream?
Generally mainstream, because non-bank lenders are security lenders and they're non-deposit taking entities. So they don't generally have a facility where you can put money in and take money out. There are two non-bank lenders that we work with that will allow you to have a revolving credit type facility, or they will put a facility in place for a short term, 12 to 24 months, depending on your property trading. So if you can trade a property within 4 to 6 months, you could probably get through 4 property deals with one facility. And then if you're looking at the near banks like Resimac or Bluestone or Liberty, probably 50% of them will have the equivalent of a revolving credit.
Okay, perfect. Speaking of those near banks or non-banks, how easy is it right now to refinance from a near bank to a mainstream bank?
Reasonably easy based on debt servicing. So the biggest shortfall that we see is people getting into hot water where they can't afford the perceived debt servicing requirements from a main bank. But again, real world affordability plays a big part here. So if you're coming from we settled one yesterday where clients have been with a non-bank lender at 11.5%. So, you know, their serviced facility is 2% higher than the bank's servicing rate. So that was a really easy transaction to move the property back to main bank, and it's a long-term hold for them. So they've built good capital. They pulled equity out with the non-bank lender because they can get some walking around money and then refinance dollar for dollar back to the main bank. So they've put some cash in the bank for the next transaction, and they've got a happy home, service the facility.
How exactly does that work then? Because I've spoken to a number of people who are with non or near banks where they are paying 11%-ish.
Yeah.
Mainstream banks are 6%, and they're going, well, we won't take it on because you don't meet the thing. And it's, well, I'm obviously paying 11%. There's a lot of people frustrated. I could even see in the faces a few people nodding, going like, where's the logic in that?
So sometimes it's a security problem, and some of you in this conversation will know what this is about, where the banks don't like the security that you've got. So non-bank lenders are a lot more lenient if the security makes sense. So in that space, in the non-bank space, if the numbers make sense, they'll fund it. So is the value LVR really good? So the value to the debt ratio good? What's your exit strategy? How do we get our money back? Other than that, they don't really care. The main bank is looking at a long-term risk profile, and if they take on a security, if it all turns to custody, how do they get rid of that security? So every single property that a bank looks at, that is the credit decision. It's you as a borrower, yeah, most people will pass that. You as a long-term client, most people will pass that. If we take this security on and it turns to custody, who's going to buy it? And do we get our money out? So for standard residential, super easy conversation. For more complex residential, multi-let, multi-units, big houses that are divided into 6 units, that sort of thing, individual titles in multi-units, that's a very different conversation because the buyer pool for that risk profile is very, very small. It's going to be another investor looking at a multi-unit who's not going to pay top dollar. He's got no emotional attachment. He's going to be looking at it dollars and cents. Does it make sense to me at 60%, 60 cents on the dollar? Great, I'll take it. And that's a real high risk profile for the banks. So, but if you've got people who are at 11% and haven't managed to refinance, I'm happy to have a conversation because we're doing a lot of refinancing at the moment. So we had 37 settlements this month, of which 23 are refinances moving from one lender to another. People just doing debt restructure and moving money. That's it. No new money, just restructuring to deal with the current rate environment.
Speaking of that, sorry, I just saw Helen's question coming through.
Sure.
I think you've kind of touched on that, but what's the processing timeframes across the different types of lendings?
So easy answer is it depends. So from the time that and I say this lightheartedly because some clients are really urgent in what they need. And if you send them out an online application, you'll have everything back within an hour and a half. So that's something that I can then submit same day. And the bank turnaround at the moment is between 2 and 8 days, except if you go to Kiwibank, which is something like 3.5 weeks. But generally, you can be in and done in a week. If you're looking at a non-bank approval, depending again on the security and what you're trying to do, often we can get funding in an hour and we can get an approval in 24 and you can settle within a week. So sometimes you'll get stuck needing a registered valuation, which then takes a little bit of time. But again, depending on the location, on where the property is, we've generally got pretty good relationships with the valuers there and can often pull some strings. So I'd say again, a week to 10 days top end. If you move quickly and you're willing to put some money into making things work, you can settle. So find a property, offer, finance, and settle within 5 days.
And what about interest rate hedging? So, if I've got $1 million worth of lending, would you recommend I just go and chuck it all on the cheapest interest rate possible?
Or... No, absolutely not. Because the cheapest rate possible at the moment is 5 years. And that is a train wreck waiting to happen. So no, bite the bullet, do 12 to 24 months. If you can get any cash to help offset the cost of that, do that, but do not lock in for long term. So we're seeing our pick is 12 to 24 months, and all the indicators currently in the economy and everyone who's involved, the powers that be who are great at crystal ball gazing, all suggest the same sort of time frame. And historically, there have been 6 similar economic events and situations since the late 70s where you've got a really big inverted yield curve, where the 10-year bond rate is cheaper than the short-term 1 and 2 year rate, which means that 6 and 12-month funding is the most expensive funding, 5 years funding is the cheapest funding. And it's been seen when there's been an increase in interest rates, a hold, and then rates fall off a cliff, and everyone who's freaking out that rates are going to keep going higher, locked long term, and then sit 2 or 3% higher than the fallen rates and have to pay extortionate break fees to get out and take advantage of a lower interest rate environment.
I'm looking at interest.co.nz, just at the borrowing rates on that.
Yeah.
And that's what we'd call bait rates, really, right? So
100%, that is 100% correct.
By having a look at it, the 5 years is the longest. They want people to generally lock in for sort of 5 years.
Yeah.
Because they believe they're going to change in that short term, and therefore you don't want people locked in for that short term.
Correct. Yeah. So they're making the short-term funding a real disincentive. And in fact, the rates that you see here, the short-term rates, these are the advertised rates, not even necessarily the discounted rates. So you can get a 5-year rate at about 6.2%, and you'll get a 1-year rate at 6.99, maybe even 6.95. So there's a solid 85-point difference in that, which for a lot of people, on $1 million, that's $8,500 difference for 1 year to run the risk of maybe being in a better position. But the alternative is that rates change by 2%, and then you're 2% worse off for 3 years after that at $8,500 a year. So no, I'd say 1 to 2. That's our pick. It's our standard advice at the moment. 1, if you can afford it, stay close to the market because it'll give you the opportunity to move quickly as the market shifts.
Yeah, perfect. Cool. Couple of final questions. You mentioned clean account conduct, but what else can we do as potential borrowers to make ourselves as attractive as possible to get the lending?
So good lending behavior. So show that you're paying your debts. As I said, put money aside to show that you have the ability and facilities to service additional debt. A ridiculous one that so many people are involved in casually, betting, TAB, Sky City Bets, a few visits to the casino. Online gaming is a really big one. That is a massive red flag for the banks. So, and you don't think it, but there's heaps of people that'll spend a couple of dollars once a week or so on online gaming, and they play silly games. And but gambling is a big one. So Controlled gambling is okay. If you go to Sky City once every now and then, it's not going to be an issue. But often what you see is that people will go to the TAB or go to Sky City and there'll be an initial advance, and then there's 2 or 3 advances in the evening at Sky City, and that's an immediate red flag for the bank where they're like, compulsive gambling. That's not a risk that we're willing to take. So, but clean account conduct, make sure, if you can, minimize the number of accounts that you have. You know, there's no reason to have 17 different accounts, because all it means is that you have to keep control of 17 accounts, but it gives the bank 17 more options to find one reason to say no. So at the end of the day, if they really want to lend money, clean accounts, good conduct, surplus funds to show ongoing debt servicing capability in an extended put position. So if you want to take on $1 million worth of debt, be putting the income aside. And if it's the difference between all of the rent is going to cover all of the debt, still put some extra money aside, account for the 25 or 30% that the banks are going to shade on the rental income, and show that you've thought about that. We've put money aside for the rates. We've put money aside for the insurance. You may find a cash flow positive rental property that pays for everything. And that's what we've done in Wealth Mentor for the last 6 years. So that's the target. But the banks don't believe that, because the banks will always take the dimmest view of what happens if you've got a vacancy. Can you survive on 60% occupancy at 60% of the rental income? So take that position and demonstrate that you're thinking of those pitfalls and that you can show that you're prepared to take on the debt that you're asking for, because then it makes it a really easy conversation for the bank. When we present the offer, we say, this is what's happening, this is what we want to do, here's how we're going to manage the debt, here's the accounts, this is what we've thought of, these are the proposed costs, we'd like to have this approved. And then it's an easy 24-hour turnaround. In one touch pass, approved, out the gate.
Brilliant. Self-employed people, how long a history do they typically need, or trading history?
For main banks, 2 years. For the near banks, they'll do as little as 6 months, but you obviously then go into sort of a specialist type category or low doc category, so you end up paying a much higher interest rate. 12 months would be ideal, but 2 years is perfect. That's the real sweet spot if we can get in.
And any difference with Aussies?
No, so for Aussies, you can only be self-employed and borrow through Nearbank. Main bank won't do self-employed Australians, unfortunately. And there we've got options for as little as 12 months. 12 months, full financial. As long as you've got 1 year's worth of full financial accounts and possibly a year to date profit and loss and a balance sheet, we can generally work with that as a deal. And then someone like Resimac will give us 100% of income, and their rate is about 50 to 65 points higher than a main bank rate. So it's really not it's not a big deal to be able to do something through Resimac, and they've got good products. Securities they're a little bit funny on, so they won't do all securities. So you may have to do a stop with someone else who's a little bit more liberal. If you're looking at buying a real derelict property, do the reno, recycle the equity, and then go to someone like Resimac for a longer term position.
And final question, interest-only mortgages, are they a thing at the moment?
Absolutely, always have been, and thankfully they always will be. So yeah, for the investor space, interest-only mortgages, absolutely. Non-bank lenders, so your traditional flipping lenders, are always only interest only. So there's no principal reduction. They repay the debt at the end of the trade. But for the long-term holds, interest only, you'll get 5 years, and then the possibility to extend 5-year blocks at a time. In the main bank space, it's a little bit trickier, because on a 30-year mortgage, if you do 5 years interest only, your debt servicing is then calculated over 25 years. If you then go back and ask for another 5 years interest only, they will then do your debt servicing on 20 years. And often that compressed loan term on original debt position puts a lot of people outside of the servicing capacity. So for many investors, we would move them every 5 years. So you move from lender to lender, shop around, get some cash, get a new interest rate incentive, but also go back to a 30-year loan term, 5 years interest only.
Brilliant, brilliant. There's one more question in there, but Nadine, I think that's probably better for a one-on-one conversation with Brendan, and probably not a recorded public forum.
Thanks, Aaron. That is correct. You have my number, Nadine. Feel free to give me a call.
So yes, Brendan's details have been dropped in. Otherwise, you can always reach out, office at Wealth Mentor, and we can connect you with anyone on there.